Welcome, everyone, and thank you for attending today's Lunch and Learn. I'm David Shaw, the Publishing Director for Family Business Magazine. I hope you've all had a great first week of your 2022, and I wish you all a happy and safe new year. Today's session is going to look at the year ahead and make a few predictions about what the market, the pandemic, and the supply chain has in store for all of us. So first, some quick housekeeping details. We welcome your questions and comments throughout. As normal, you would enter that question underneath the video screen that you see. We're going to go for about 30 minutes today, and we'll get to as many of your questions as we possibly can. So our topic today is a 2022 outlook on the financial markets and the economy from Altair Advisors Head of Investment Research, David Lynn, and Director of Strategic Growth, William Shannon. They're going to address issues of employment, inflation, tax legislation, and other key factors that will be shaping the market and the economic outlook for 2022. So, Bill, I'm going to turn this over to you now, and we'll be back with questions. Thank you.
Thank you, David, and welcome, everyone. Just a couple of slides here. I want to give, many of you may not have heard of Altair Advisors and what we do and a little bit about us. So next few slides, I'm just going to run quickly through that. We are a registered investment advisory firm. And if you look at the left side of the slide here, we're focused on advice. We're not a sales organization. We're a service organization. We're privately held and independent, and we're broadly owned by our employees. Our core competency is working with taxable U.S. individuals and families and their related charitable entities. We are a fiduciary, and our fee-only compensation model provides a peace of mind that our clients are being served and not sold. If you look at the next slide, there's three core areas that we spend with our clients. Investment management, which is what we're going to focus on today. Client education is another component of our business, as well as financial planning. If you look at the next slide, this sort of is tough to see, but if you look at about 4 o'clock on this slide, these are all the areas that are sort of, I call the iceberg slide. That is the things that we do for our clients and the support services that we have. If you look at about 4 o'clock, that's the research team. That's what David Lynn, which you're about to hear from, leads. And he's also in the investment committee, which is about 3 o'clock on this slide. He's a member of the investment committee. So with that sort of primer about Altair Advisors, I'm going to turn it over to my colleague, David Lynn. David?
Thanks, Bill. I appreciate it. Thanks for having me. It's an honor to be here, and I hope everyone's having a great and happy new year so far. As David mentioned, I'm going to spend the bulk of the time talking about a little bit of a review of 2021, but also sharing what our outlook for 2022 is. And I promised that my presentation would not go over 25 minutes, and I will have some time at the end for Q&A. So please submit any questions that you may have. I apologize in advance. There's a lot of slides to go through, so I'm going to be pretty quick about it. But if there's anything that you would like to have me address in further detail towards the end, please do not hesitate. The first thing that I wanted to share with all of you is every quarter, our research team puts together a little bit of a cartoon, if you will, with the help of a very talented artist in Idaho named Noah Cressy. And what we try to do is we try to capture what has been going on in the quarter and the prominent themes that we are thinking about. So if you think about 4 quarters ago in January of 2021, vaccinations had just been rolling out. We had this grand reopening of the economy, of the global economy, and everybody was very excited. And we wanted to depict at the bottom of this global economy was the safety net. And it was really kind of a blank check that was being written by central banks, if you will, to help support the economy through both monetary and fiscal stimulus. And then in our next slide, here, it was really the second quarter. So this was probably closer to April of 2021. We wanted to show that the US economy was booming. We had these phenomenal stimulus packages. 2 were from President Trump at the time, including the CARES Act. We also had one from President Biden that was approximately $1.9 trillion, known as the American Rescue Plan Act. And that was kind of in March of 2021. And really things were lifting off and we were seeing great things in the economy. As you can see there, that's Fed Chair Jerome Powell and Treasury Secretary Yellen, who were kind of monitoring through ground control. And then bring us to kind of the summer. We had an Olympics theme going on here. And what we try to depict here is that the bull, and this is represented by the stock market, was doing phenomenally well. And it had really cleared the the initial COVID-19 hurdle with vaccinations. The economic reopening had already taken place. But now there was another hurdle there with inflation and the Delta variant that the bull market still needed to overcome. And that's the thing we try to depict here in this cartoon. And then last quarter's cartoon is really something that we're seeing today. It was a Halloween theme because it was October, but we feel like Fed Chair Jerome Powell is in kind of this corn maze. And he's trying to navigate through this corn maze. And everywhere he turns, there's kind of an inflation scarecrow, or there's geopolitical concerns with President Xi. And we have all these like mummies walking around who represent all the job openings that we have, 10 million or plus job openings today in the market. And so this is what we were trying to capture there. And we use this as kind of an icebreaker with our clients to help frame the conversation and make things a little bit light. Okay, so turning to really quickly setting the stage for what happened in 2021, risk assets, which are more equities and REITs and so forth, really had a strong year. The S&P 500 had 70 new all-time highs in 2021. That was the second most on record that we ever had, second most to 1995 that had 77 new highs. And so the S&P 500 returned about 29%. Growth slightly outperformed value. And while small caps did fairly well, it did underperform large caps for the fifth year in a row, which was very surprising. And then international markets generally did pretty well, but the emerging markets in particular struggled because of China. China represents about 40% of the emerging markets index. And with China's big crackdown on big tech and gaming, along with things like the Evergrande real estate troubles, that really shook the markets there in China. But REITs, which are also known as real estate investment trusts, rebounded very strongly after a very difficult 2020 when the global shutdown and working from home really decimated the REIT industry. And then finally, we show bonds. Bonds were fairly flat, given that interest rates, while volatile, really didn't move all that much, although they did slightly lift a little bit higher. So that really sets the stage for the returns that we saw in 2021. What was particularly interesting to us, and this is one of my favorite slides that you're seeing in front of you here, is since 1987, you can see in the blue columns, that represents the price return of that calendar year. And as you can see, we've had a phenomenal stock market run over these last many years. And for the most part, stock markets tend to go up, at least the S&P 500. What the red mark represents within each calendar year is the drawdown or the decline in the markets during that particular year. And so you'll be surprised to see that despite all of these phenomenal returns, the markets experience some sort of decline, significant decline in many cases during the year. So for example, if you just look to last year in 2020, the markets ended up about 16%, the S&P 500 did. But recall in March of 2020, we had this phenomenal drawdown of 34% when the global pandemic just started becoming known. And then if you look at 2021, the market was up about 28%, as I mentioned before, but we only had a 5.2% decrease. That was the largest drawdown that we experienced in 2021. That was the fourth smallest pullback since 1987. Typically, the average drawdown in any given year is about 15%. So that was a little bit surprising last year. So what's going on that's going really well in the economy? Well, global growth is strong and has returned fairly well. If you look at the IMF GDP projections that were posted in October, it was predicting pretty strong growth in 2021, which was a rebound off of a very weak 2020 because of the global pandemic. But even in 2022, we're looking at still very strong GDP growth rates in the US and overseas. And so, normally if you're experiencing a 5 to 6% growth rate, these would be phenomenal years. Now, there are some concerns and challenges that we're facing that we're going to get into, but otherwise we would be talking about the roaring 20s again, given these numbers that we're seeing. And these are like the highest GDP growth numbers that we're seeing in the last 30 plus years. So what is really driving the US economy? Well, there's a couple things, starting with the consumer, which represents about 70% of US GDP and is really the backbone and the engine for US GDP. And the consumers right now are flush with cash. Asset values have gone up considerably. Housing prices are strong. The government stimulus programs that we had in 2020 have really put a lot of cash into the pockets of consumers. And they are spending. They're spending very strong and really driving the economy. And so that's what the chart on the left side shows, is how much the net worth statements of each of the U.S. Consumer has risen over the last several years. And on the right-hand side, you really show how resilient the spending has been from these consumers. Now, if you look at the light blue line on the chart on the right-hand side, there's a little bit of a disconnect because consumer sentiment has weakened over the last several months. And a lot of that is because of course, COVID and the risks of the Delta variant, and now we have Omicron. But we also have inflation rearing its ugly head more and more. And so despite spending being strong, sentiment has been a little bit weak. The other thing that has been really positive is corporate earnings. And corporate earnings from companies are often what drive a large portion of stock prices. And for the most part, earnings have returned and have been extremely strong. We're expecting approximately 45% earnings growth. Now, that is coming off a very weak comp from 2020 when earnings were pretty much flat to negative. But we're still looking for pretty high single to low double-digit growth in 2022. And so people are fairly optimistic about the corporate environment heading into the year. The thing that we hear a lot about on earnings calls, the most things that people are talking about are labor shortages, inflation, and supply chain issues. And so we're going to get into that a little bit more. But for the most part, things are going along really well in the economy. If you look at the leading economic indicator index, that is all trending in the right direction. Economists use this indicator as kind of a directional prediction of how the overall economy is trending in future months. And so what this really kind of tells us is that there are low expectations for the most part for experiencing a recession in the near term. Okay, so let's get into some of the risks that are troubling our economy today. As you know, the supply chain is a very complex ecosystem. And companies around the world had been operating very lean in terms of their inventory supplies. And anytime you throw even a slight monkey wrench into the system, it tends to cripple the supply chain. And then you add in something like the global pandemic, where you have countries like China and Vietnam, where they're often producing and manufacturing a lot of these goods, completely shutting down. Ports in the US were shutting down and workers were staying home and so forth. And so such a massive disruption has caused a tremendous backlog and in our system. And it's going to take a little bit of time to work it out, but we're confident that it will happen. One of the charts that before you that I wanted to show you is the ports in both on the West Coast and the East Coast in Long Beach and Savannah. And pre-pandemic, you would typically see maybe 0 to 1 or 2 ships that are waiting to be unloaded. In Long Beach today, there are over 100 ships waiting to be unloaded right now. And it's not just a matter of getting them in there and unloading them, because it's really more complicated than that. They need the receiving people to be there at the dock. They need the trucks to be there to distribute them throughout the country. And because of labor issues, because of worker issues, a lot of those receiving people and trucks are not there at the docks to be able to unload. So if you look at Savannah, there's normally 0 to 1 container ships out there. They have 13 right now there. And so all of this backup in cargo ships is leading to higher costs. As you can see there on the left-hand side, shipping costs are going up. And we're also seeing prices rise across the board. If you go to the pumps, you can see firsthand that gasoline prices are higher. Groceries are more expensive. I know my Costco bill has increased significantly. And so that's what you're seeing there in the consumer price index on the right-hand side, has really shot up. And this is a basket of consumer goods and services that includes housing and apparel, food and beverage, medical care, and so forth. And those are all elevated. And part of the reason that they're elevated is because in 2020, we had kind of a deflationary period. And so, if you look from year to year growth, that's going to be a very high number. But we do think that inflation has likely peaked and that it'll start to moderate. Please understand that I'm not suggesting that we're going to see prices go back to pre-pandemic levels, because that's not going to happen. But we are going to see that inflation rate start to decelerate and get closer to kind of a 3% level. While there are stickier parts of inflation like rents that will remain elevated for a period of time, there are also other components that make up of CPI that we think are going to go down. For example, used car prices. Used car prices are elevated right now. We do not expect that to remain indefinitely. At some point, nobody's going to keep paying higher and higher prices for my 15-year-old Honda Accord. That's just not going to happen. And so the other thing that we're looking at is that supply chain is showing signs of healing. So if you look at capacity utilization, which is a measure of productivity that shows an organization or a company's potential output, that is actually improving quite a bit. As you can see, it's starting to move back closer to the trend line of pre-pandemic levels. And so we think that as the supply chain does improve, that is going to help out quite a bit in calming some of those price increases. So one of the things that people care about in terms of inflation is not only how much are we spending and how it's hurting our pocketbooks, but also how do stocks and bonds perform in previous inflationary during previous inflationary periods. And as you can see here on this chart, they generally hold up pretty well as long as inflation is moderate. And so if inflation is persistently high or we're experiencing deflation, those are the tails that we're trying to avoid, because that's where you kind of see stock and bond performance starting to suffer. But if we're kind of in this 0 to 4% annualized range, that is a manageable range that tends to be good for the economy, for companies, as long as that they can pass those on to the consumer, and the consumer is experiencing a good economy to be able to pay for those higher prices. We'll generally see that continue to press on. So inflation is not always necessarily bad for stocks and bonds, is the point I'm trying to make here. Let's turn our attention now to the job market, because this is something that has been grabbing a lot of attention lately. Jobs are on pace with earlier recoveries, and I think that people have been getting very impatient about the progress of jobs returning to the economy. We ran a slide here and took a look at the last 6 recessions. That's what these lines represent. I know it's a little bit confusing, But what these 6 lines represent within the last six recessions is how long did it take for jobs to finally return back to where they were prior to the recession? And as you can see here in this blue line that had the severe dip in 2020, and it's kind of come back, we are kind of in month 20 to 25 right now. And historically speaking, that's about average from the last previous recessions, the last 6 recessions. If you look to the dot-com bubble that burst and also the global financial crisis, that took several years for jobs to fully recover. So even though we are still about 4 million jobs under pre-pandemic levels, in terms of the duration of that time, we're still okay there. The other thing that I wanted to show you next is it's a different type of a job recovery. We have a significant number of jobs available out there. More than 10 million jobs are available to people and that are looking for people to work for them. And I think a lot of people are experiencing that, right? If you go to restaurants or stores, you see that there are a lot of groups are stressed and understaffed and looking for workers. And it's not like unemployment claims are very high. We are at 52-year lows in terms of employment claims. This ticked up recently, but still, it's really showing that Omicron hasn't caused any mass layoffs so far because we haven't seen a high number of unemployment claims come through. One of the things that is complicating things is really this labor participation rate. This is lagging tremendously from pre-pandemic levels. And we're trying to all understand why this is. Why haven't people come rushing back into the workforce? Well, there are a few reasons for this. A lot of people have opted for early retirement once the pandemic hit. There are COVID and health related issues. A lot of people just aren't comfortable returning back to the workforce, so they're sitting on the sidelines. Unemployment benefits were a huge boost to people's pocketbooks, as we talked about. And so a lot of people are just sitting on the sidelines because they have this cushion that they're working through. There are also reasons because of childcare issues. Some daycare centers have closed because of COVID. Some parents are concerned about sending their kids back to wherever it is that they were having their children take care of, and so that meant that they had to stay at home. Some schools have been closing periodically and so forth, and that has been disruptive to people getting back to full time. But we think that as we work through the pandemic, we will continue to slowly grind away at this number, and that we will continue to see an improvement. And one of the reasons that we feel that this is the case, if you look at this next slide, is because disposable income is starting to slip below trend. And so we're starting to see people work through a lot of the cash and the savings that they're holding on to. And at some point, they're really going to have to come back into the workforce to earn a living. This is our slide on COVID. There's nothing really here that I can say that is probably new to any of you. All of you have been well versed in this as much as I have. The one, I guess, silver lining, if you will, with Omicron is that it while very contagious, doesn't appear to be as deadly and causing as many hospitalizations as previous variants. And so the risks seem to be a little bit lower and something that we can work through. And so hopefully we can reach this level of herd immunity and continue to kind of live with COVID and continue to see the markets and the economy push through. Lastly, I kind of want to turn our attention to kind of what the Fed is doing. I know I'm coming up on 25 minutes here in the presentation. The Fed has been instrumental in propping up the economy. They cut interest rates to zero. They were buying $120 billion worth of bonds per month. And they really increased the balance sheet. They doubled the balance sheet, if you will, to around $8 trillion, which is a massive amount. But they're starting to take their foot off the gas pedal. This does not mean that they're reducing the balance sheet yet. That just means that they're buying less bonds, and they're pulling back so much that they think that they're going to be completing their new bond purchase program by March of 2022. And that's going to really suck out a lot of liquidity that has been available in the markets. And that'll hopefully slow down the pace of the economy and also rein in inflation a little bit. If you look here on the next slide, in terms of rate hikes, the market is anticipating, this shows 3 rate hikes. It's a little bit closer to 4 now after the minutes came out a couple of days ago. But the thing that I wanted to press upon you here is in the next slide is that this shows you that the first rate hike is typically not that detrimental to stocks. If you look at all the rate hike periods back to 1983, you can see here that the S&P 500 is on average up about 8% in the 6 months following the first rate hike. And even in fact, equities tended to rally in the months leading up to the first rate hike. So it's really not necessarily a kiss of death. It's really about having the Fed manage the rate hikes and how they're going to handle the bond purchases prudently and not make a policy mistake. In terms of what the bond market is showing, you can see here that the short end of the curve has been moving up to anticipate the rising rates. But really, it really hasn't changed much over the course of the year. There's certainly been a lot of volatility. The 10-year is now back at about 1.8%, which is what it was around the March levels. But the bond markets are really saying that growth will be fairly moderate moving forward. But so too will inflation. And so it doesn't think that it's going to really get too far out of control is what the bond markets are saying. I wanted to put a slide in here to talk about the fiscal package. The Build Back Better Act is really on hold right now. That was $1.75 trillion. Odds are something will get done with midterms coming up. But as many of you know, Senator Joe Manchin really wants to address 4 key categories that I've highlighted here in the red box with climate change and child tax credits and healthcare spending. He really wants to pull in the spending quite a bit. And we think that there's going to be some compromise, but there is going to create some fiscal drag as there's given the inability to pass Build Back Better, which is going to take away some of the stimulus and pump the brakes on the U.S. economy a little bit. But we don't think it's too bad because the economy was growing pretty fast. Okay, the last slide that I'm going to leave you with here is that, yes, markets were very strong in 2021. And people are concerned about 2022 and a pullback and so forth. Well, if you can see here, I pulled since 1924, the S&P 500 has been up at least 20%, 36 times. And that's what I've pulled here. And in the previous 35 times where the market was up at least 20% or more, in the following year, the S&P average return was a positive 11%. And nearly 70% of those readings were all positive. And so this is no guarantee, obviously, that we make no guarantees here about market performance and how it's going to go. But I just wanted to point out that a high return doesn't necessarily mean that there's going to be a mean reversion the following year. That there tends to be some momentum in the markets. We all know it's not going to go up forever. We shared the slide that there's going to be volatility throughout the year. But overall, we're fairly constructive and optimistic about where things are headed in 2022, at least in terms of the economy. And the big risk out there is inflation, obviously, and a policy mistake, but we're fairly positive on that. And we think it's things are going to be continue to move along as long as COVID and the variants remain somewhat under control, and we can kind of live on with that. Okay, so I know I've eaten up most of the 30 minutes there. I apologize for that. I did want it to move to a Q&A session. And David, do you have any questions that people have been asking?
I do indeed. First, a comment, David. That was very interesting, and I know you had to go quickly, but a very interesting presentation. And it strikes me that you're quite bullish on 2022. Would that be a fair characterization?
Yeah, I would say we are not bearish on 2022. Okay. That's how I would say it. We certainly feel good about the trends that we're seeing in the economy with the jobs. We are not overly scared about inflation. We think it's going to take a little bit longer to work through. If anything, Omicron will likely push that timeline out a little bit further, because you've got things like China, which has a zero COVID policy that will completely shut down its ports to avoid further spread and so forth. And that's not going to be good for supply chain. But we do think that that's going to eventually catch up to demand.
Okay. Well, so one of the questions was, what is your feeling on, you've addressed this a bit, but your feeling on the impact of Omicron? When do you see us, I know you're not an epidemiologist, but, is it March, April that we start to feel that we're coming out of it?
I don't know. The thing probably the listeners on this call know as much as I do here, so it's hard to predict that. But what we're seeing here is that Omicron appears to be manageable so far. People are getting very sick. It's very contagious, but it doesn't appear to be too severe. And that, from what I'm reading, might be a good thing, is if a lot of people are catching it, it's not that harmful, and people are able to continue going to restaurants and working and keeping the economy open. That is the key thing there. And so as long as we can keep the ball moving forward and kind of get past these winter months where flu season and cold season is going to be harmful, then I'm pretty optimistic about moving it towards the summer and seeing a better environment there.
Okay. This is, if I understood the question properly, if rate hikes seem to be good for stocks, but what do you anticipate the impact of the increase of cost of capital to be?
Yeah. So keep in mind, interest rates are still historically very, very low. Okay. And so even if the Fed decides to do 3 or 4 rate hikes that are predicted in 2022 here, which is no guarantee, by the way. I think they're going to be fairly reactive about what they're seeing in the markets and the economy primarily. Even if they raise it 4 times, the short end of the curve is only going to be at 1%, right? And that's not going to be, while that's going to put a little bit of pressure, and it's going to hurt bonds a little bit and so forth. We think that as long as the economy is growing at a rate and people are successfully employed and things are going well from a corporate earnings side and spending continues to be strong, we're fairly optimistic we can overcome a fairly low hurdle of 1%. It's not until we get above kind of that 2 to 3% level at the short end of the curve that we really start to fear a drag on the economy.
Okay. I'm going to put in one final question here. Do you believe that equities will outperform fixed income bonds in 22, assuming inflation is moderate?
I do. So there's this acronym called TINA, which means there is no alternative. And with interest rates so low, you're still better off in riskier assets. Now, there's going to be volatility. That does not mean that we're not going to experience periods during the year where stocks are down 10%. That could easily happen once or twice. In fact, as we talked about in the earlier slide, a regular drawdown is about 15% during the year. But interest rates are going to probably rise. They're going to go higher. We think that as we get through Omicron, we're going to see the longer end of the yield curve come up, and that's going to be a headwind for bonds. But keep in mind, we still hold bonds in our clients' portfolios because it serves as a ballast and to mitigate risk. Because when we go through these volatile times and there's a flight towards safety, towards bonds, that is really good for portfolios because of the low correlation of returns between bonds and stocks. So I do think that you need to be more weighted towards equities, but that's not a call to eliminate bonds in your portfolio, depending on what your risk tolerance is.
Terrific. Well, thank you so much, David. This was, again, a really wonderful session. I want to thank you and Bill for giving of your time and expertise to get us started on this year ahead. Let me just see here. Our next Lunch and Learn, everyone, will be held on January 26th, when we'll be looking at growth strategies for family businesses. I'd like to also invite all family business members in our audience to join us for Transition Spring 2022, which starts March 30th in sunny Tampa Bay, Florida, and in person. Registration has been strong so far, so we're hoping that everything goes really well with getting over the peak of the Omicron variant here. So with all of that, I'd like to wish you all a great rest of your day, a wonderful weekend, and of course, a very, very happy New Year. We'll see you at the next webinar.